In this video, we are going to explain payment flexibility with high cash value life insurance policies. So we'll begin with a question. When you hear the word whole life insurance or insurance, what typically comes to mind? Premium, bill, expense, and I have to keep paying it until something happens where that insurance claim is paid out with a life insurance policy until I die. Now, when we take a look at a high cash value life insurance policy, there's really two sides of it. I should say one side that's very attractive, individuals we talk to looking at the cash value, what are some core benefits to the cash value? Safe, liquid, tax-free area to position money. I can borrow from the policy, and the unique feature to policy loans is that once a dollar passes through the cash value of a life insurance policy, regardless if I let that sit and grow, or if I borrow against it, I continue to receive dividends and interest on it. There's no lost opportunity cost. A ton of people are attracted to that. Then we've got the fact that it is a whole life insurance policy. Premiums are due. It's a bill. I pay the same amount every month, every year. Do I have to do that? Do I have to make payments forever? Or can I turn the policy into a flexible savings asset, add more and less, adjust my payments? The answer is yes. It's just knowing how to do it and then working with a company and product that accommodates. Let's get into some details here. So we go through policy design all the time, right? When I pay a dollar into a life insurance policy, where can my money go? Premium or the PUA component? Those are the two primary areas. There are other riders and such, but these are the two most important pieces. With the base premium dollars, so understanding how these work, it is a fixed bill, fixed expense. It is possible to adjust that, but it is very, very time consuming and does not always make sense. Once I start a policy, 99 out of 100 cases, I am locked into that premium for life. Now, it is billed for the life of the policy. What that means specifically is if I purchase a policy that is paid up at age 100, that means premiums will be billed up until age 100. If I purchase a policy that is a 10-pay whole life insurance policy, premiums will be billed for 10 years. So that's where different products come into play, and it's good to be aware of the different options. Now let's assume we go with a traditional policy, that premiums are payable for 100 years, or I should say up until age 100. Does that mean that I have to make payments until I'm 100 years old? Because that's what the contract will state. Not necessarily. Here's the thing. While the bill is fixed, the premium is fixed, it's payable for the life of the policy unless I execute one of these options. The first is a premium offset. What this does is allow the dividends and interest in a life insurance policy to pay my premium for me. Typically, once I've built up the cash values in a policy and the dividends are exceeding the premium, it can very easily pay for itself and continue to grow. Nice option to be aware of. Very common. You may have heard the expression, you can fund the policy for so long and then allow the dividends and interest to pay the premium for you. The actual action step I need to take or I need to execute to make that work with a policy is a premium offset. Then I have the reduced paid up option. Good option to be aware of. This completely eliminates the premium. Meaning if I have a policy that is paid up at age 100 and I am 65 years old, I elect to go reduced paid up, the premium's gone. Chop it off. Advantage is the advantage is now that the premium's gone, my dividends and interest do not have to pay a premium for me. They just come back to cash value and help my cash value and death benefit accelerate, often at a greater rate. Every time you'll see that to be the case when looking at the guarantees. Now, the disadvantage to it is that I can't pay any more money into it. The reason why is once I've had a whole life insurance policy for some time, it gets better and better. If I continue to feed the beast, keep pumping money into that policy, it keeps on growing. I'm adding more money into a policy that's performing often at a high level. So it's good to consider, what are my goals, right? Do I want to pay in forever? Or maybe I'm in a situation where I say, hey, after 10 years, I'm probably going to be done funding it. Keep that option open where I can keep paying in maybe a lower amount. But if I hit 10 years and I want to shut it down, a reduced paid up option is great to be aware of. Once I go that route though, there's no turning back. Oh, and by the way, with the reduced paid up, I can still access the money. So I can borrow and repay, take income from it. I still have complete control and access over the cash value. And then the last option, policy loans. You can elect to have a loan pay my premium for me. This does not always make sense. Some individuals' situations call for it. You know, maybe my premium's due August. I run into a bind in August. I say, hey, have the policy pay for itself through a loan, and then I'll just pay that loan off in September once my cash flow comes in or I'm able to make that payment, whatever it might be. It is an option that's good to be aware of. PUA rider. PUA stands for paid up additions. Anytime I add money into PUAs, that purchases me what's called paid up additional life insurance, added whole life death benefit. Why it has the term paid up is because these payments are optional. I am not required to make those payments like I am with base premium dollars. It's optional. I have a lot more flexibility here. If I add 10 grand into a PUA component, that immediately purchases me, call it $30,000 in whole life insurance. The amount it purchases will vary based on my age and gender, health rating, all that good stuff. Now, excuse me. Now, while it is optional, it can be set up in a variety of ways. It can be set up where it's billed with the premium. For example, if I'm making a $100,000 per year payment into a policy and I have a $10,000 minimum premium, $90,000 going into PUAs, you can design the policy where everything is billed at the same time. Assuming the insurance company and underwriters approved it, you can do that. So I'm billed at the same time, but the thing to be aware of is that PUA component, while I'm billed for it, if life happens, I can easily reduce that. I can cut it down to 50, I can cut it down to 0. So I can set it up where I make the whole payment, base premium and PUA together, but I do not have to. So I can set it up to be billed with the premium, or I can design it where it's very flexible. And in green, we've got here that it depends on the insurance company, because it does. Every insurance company has different rules. To give you a little bit of info here, when it comes to the PUA component, some companies will allow me to add PUAs into a policy at my leisure. For example, using the situation we just described, I'm paying $100,000 into a policy. I have a $10,000 base premium. Some companies will literally allow me to commit to $10,000 and add the additional $90,000 100% at discretion. That would be paid on an unscheduled PUA basis. I can just throw it in whenever I want. Whether I hit it or not is up to me, because I'm the policyholder, control, all that good stuff. That's very flexible. Some companies won't allow that. They'll say, hey, if you just want to throw money in at leisure, you're going to have to go through medical underwriting. Remember what PUA payments do? They often buy us more death benefit. Some companies view that as a liability. Hey, why are you adding money all of a sudden? Did you find out that you just were diagnosed with a health issue and you may die soon? You're trying to cash in for your beneficiaries? That's not often how we think, but the insurance companies are looking to protect themselves and other policyholders. So that's why some companies may not allow us just to add money in at leisure. Good to be aware of these things. Right? Some companies allow us to make adjustments without underwriting one time per year. All companies have different rules. We can do a whole series on that. So let's look at an example here. Assuming we have a policy with a $10,000 MEC limit and a $1,000 minimum premium. That allows me to commit to $1,000 and add up to $10,000 at my discretion. I could literally follow a schedule like this. Base premium, that would be my commitment, $1,000. Let's assume year 1, I paid in $10,000. Year 2, 5. Year 3, $2,000. You see year 4, another 10. Year 5, $3,000. Now what we've got in red, rollover space, that has to do with the MEC laws and MEC limitations. Depending on the company, and if they allow it again, many will allow me to make a big catch-up payment like this. Or even though I have a $1,000 base premium, I could have paid in $10,000 per year. I did not, and with the MEC laws, any unused MEC space will roll over year to year, and I can make big catch-up payments. The main point that I'm trying to demonstrate here is, here's my net out of pocket. Let's put this in a different color. Under payment, 10K, 5K, 2K, 10K, 3K, 30K. And if it's a smaller number, that can be several $100s. If it's a larger number, we can add a zero or two. Point being, we can design a policy to be very flexible. As always, I hope this helps. Reach out with any questions, and we will talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.